All right. Well, let's officially kick things off. Welcome to today's session. Make sure you can hear me all right. If you can hear me out there in webinar land, just give me a big hello into the chat. You should see a little section over on the right-hand side of your screen where you could type in, hey, Pierre, great to have you here. Richard, Kumar, Doe, James, Brianna, great to have you here. Rajinder. All right. And you should see on my screen, or on your screen, you should see my screen, a thing that says the options JumpStarter, and it looks like a bunch of jumper cables, like you're about to start a car. Let me know if you see that, and that'll let me know that that's working. Kevin says, can hear you clearly. Hey, Sam, great to have you here. Perfect, Mark. See it? All right, perfect. Well, why don't we officially get things going? I'm excited that you're here. Hopefully you're excited. You've been looking forward to this. We actually haven't taught this topic in about a year here at VectorVest. And so it's great to be able to do this again. I'm excited that you are here. I'm also joined by some of my members on our team. I'll introduce them in a bit. But before we get officially started, I like to tell you how to get the most out of the session. I call them the 3 gets. I'll go through them kind of quickly here. Get something to take notes. All right. Pen, paper, drink. Some of you take notes on an iPad or whatever electronically. I'm old school. I like pen and paper. Whatever you need, get it. That way you don't have to go find it when we start going through some of the material, because we have a lot of examples to look at. Get rid of distractions. You don't want your phone to be buzzing and beeping and flashing, or someone knocking on your door. You don't want any of that, because you really want to focus, because we're actually going to be going through the techniques today. So you're going to learn how to do these trades in today's session. So make sure you're fully focused and you are ready to learn. Okay, so those are our 3 gets. And once you have all those 3, we are ready to kick things off. All right. We are, looks like we're streaming as well. So perfect. So let's officially get started. This webinar is titled The Options JumpStarter. It is a beginner's guide to profitable options trading. Like I said before, I'm really excited about this because I'm going to be showing you exactly what you need to know to start using options in your trading. All right. And let me just make sure my screen is still showing. There, perfect. Good. All right. So let me ask you a question. I want to gauge who's here with me. And now you should be seeing on your screen a question for you. And it says, how would you rate your experience level with options? And I'm going to give you a few choices, just a 1, a 2, a 3, or a 4. Okay. Now, when I say a 1, you would type in the number 1 if you are a true beginner with options. Maybe you've heard about options. You know that a thing called a call and a put exist, but you've never really gotten in there and done anything with them. That would be a 1. A 2, if you're like the next step up from that, maybe you've bought a call or bought a put. Maybe you've done a covered call. Type a 3 into the chat if you've maybe done a multi-leg trade, like a spread. And then type a 4 in there if you consider yourself very experienced. You've done everything, like an iron condor, a butterfly calendar. You've done all this stuff and you kind of know this, and maybe this will be you feel is a refresher. All right, I'm looking at the chat. Numbers are flying through. So I've got Imran, Doe, James, Jean-Pierre, Frank, number 1, some other number 1s in there. 3.5 says Kevin. I got a Mike is a 3, a Jim's a 2. All right, so I'm seeing a good portion of what's coming in are 1s and 2s. So I'll say to you, you are definitely in the right spot today, because like the title of the webinar says, it's a beginner's class. If you are a 3 or a 4, I bet you'll still learn something. Okay. It might fill in some of the blanks that you might have. All right. One of the things I like to start the webinar off with is that if there's one thing I want you to understand from today's webinar, it's this, what you see here on the screen. Until you know how to use options correctly, your portfolio will never be able to achieve its full potential. That's why today's webinar is so very important for you. You could be a successful investor. I know plenty of them, right? You're just buying and selling stocks. You could be successful at that. But until you learn how to use options, you're not going to be able to unlock that next gear. Kind of like a car. You could drive a car and be in first, second, third gear, and you'll go, but there's a couple other gears that are there, like fourth and fifth gear. So once you unlock those, your car's going to be able to go faster. So that's why options is so important for you. And in today's webinar, my promise to you is that you're going to see how you could use options, and you're going to learn how to use options the right way to help possibly double your annual returns. And it seems like a bold claim, but you're going to see how that is possible today. All right. Now, today I am actually joined by this handsome fellow over here. His name is Ron Wheeler. He's our manager of options trading here at VectorVest. And not only does he does our coaching of our options classes, he is also one of our coaches of our retirement group, where options are used for both income and protection. So actually, let me introduce him because he's going to be in the chat. I highly recommend you take advantage of having him in the chat to be able to ask questions throughout today's session. Ron, can you hear me okay?
Yep, I can hear you loud and clear.
Oh, perfect. I can hear you as well. All right, so welcome to the session, Ron.
Thank you.
Now, I told everybody you are our manager of options trading, but you also help our retirees with options. Mm-hmm. And the reason I bring up that topic is because a lot of people who are joining today's session who are new to options, they just kind of hear horror stories about options. They think that they're risky and they're only speculative people should be using them as like lottery tickets. Now, what would you tell people who have that concern that they're like, that options are risky?
Well, bring it down to the core. Options were originally created for risk. They were created to reduce risk on positions and decrease monetary loss. So that's what an option is all about. And I kind of put it into a personal perspective too. If somebody were to ask me, hey, Ron, describe yourself as a trader. Number one, I'm cheap. Number two, I don't like risk. And then think about it. I'm a full-time options guy. I'm cheap and I don't like risk. Options are the perfect vessel, if you will, for reducing risk and reducing costs for trading. It really is something that I think every investor should know, at least the basics of, to take advantage of it.
All right, cool. Well, folks, take advantage of Ron. So he will be, because I can't read every question that comes in. When we go through today's session, ask questions in the chat. This is a live session. Ron's here. Other members of our team, like Steven, is here. Please take advantage of them in the chat. If you have a question that comes up, just ask. We are here to help and to help make sure that you understand this topic. Sound good? All right. Well, a little bit about me. You know about Ron. I've been here at VectorVest for 25 years. Holy cow. 25 years. Before that, I used to be a third grade teacher, and some of that teaching style still comes through in these webinars. So when I put this webinar together, I tried to take it from the standpoint of like, hey, I want to make sure that people who don't know options really have a solid understanding of what options are when they leave today's session. I also love to have fun when we go through the session. I love to interact. I love to ask questions. You feed me energy by interacting with me in the chat. So please do that as we go through the session. If you're good with all that in the chat, just give me a big yes and it'll let me know we are ready to move forward. Andrew, Blair, James, you're all ready. Awesome. Well, why don't we move forward? Like I said. All right. A lot of people, when they come to us, and like I said, I've been here for 25 years. I've talked to a lot of our clients. They say, as it pertains to options, they just don't know where to start. they kind of feel lost, which either causes them to say, you know what, forget about it. They drop it. They make mistakes. They feel confused or intimidated by all the terms out there. There's all these horror stories, but they say, you know what, I really want to learn how to use options because I hear these other stories where it's a great way to leverage my money. Right? When using options, you're going to be able to get the same or even better returns using less capital. And when you're trying to grow your account for retirement, this becomes extremely important. So today's agenda, this is what I want to show you today. I want to show you how to, first and foremost, filter out all the noise. So that way you know exactly what the important terms are now. Next, we're going to take a look at when is the best time to place option trades. After that, we're going to talk about how to correctly set up your option trades. And then lastly, we're going to take a look at the 5-step option trading system that we use here at VectorVest when placing these trades. And what I'm going to try and do is, if you stick to the end, I'm going to try and remember to get you a copy of the slides. I put them together in a PDF for you. So I'll just drop it into the handouts area for you so you can download and print. Well, it's up to you on whether you want to print them out. They're in color. You might just want to save a copy. All right, but stick to the end. Just remind me when we get to the end. I'll give you that PDF at the end. All right, I'll give you 10 seconds to answer this question because I already asked you a question. I want to know, for you, what's been the hardest part about trading options? You know, some people say it's like finding the right stock to trade. Some people say it's knowing when to exit an option trade or just trying to figure out how to place it with their broker. You know, for you, what's been the hardest part? Eric says finding liquid options. Richard, when to exit. Repairing them, says Brett. Exiting the trade, says Brianna. Doe says overall just understanding them. Volatility, says Kumar. Managing the trade, Craig. Bill says not knowing what to do. Which option to trade, how to place the trade, deciding when to make a trade. All right, so, I mean, you're in the right spot, right? Sounds like you need to know kind of the 5 steps that we're going to be talking about at the end today, where we put it all together, knowing what to trade, when to trade it, how to put it together. I want you to write one thing down, though, because those are all kind of individual items. You're going to see as we go through the session today that your overall system is actually going to be the thing that determines your success. Not whether you know what delta means or that you know how to find the stock, but the overall system. You need a system in place, and that's going to be the thing that determines your success. Okay? Section 1, like I promised you, Section 1 is how to focus on the most important. Because there's a lot of terms out there, and as you gain more and more experience with options, you'll learn those other terms and what they mean. But today I want to focus on the main ones, like the horse with those little blinders on. You're going to focus on what's in front of you, the most important thing, and not get distracted. Because there are a lot of terms with options: gamma, theta, delta, condor, strike, all that stuff, right? You might feel there's too much information, only the experts can do it. I put this slide up here because my old broker, when I went into the options area with my old broker, it looked like this. And if I get my laser pointer out here, you see all these things. It's like, holy cow, I'm not even going to trade this because you got all these numbers going down here. You've got all these dates going across here. It's like, I just want to place a trade. I don't even know what all this stuff means. So what we're going to do first is I want to make it really simple for you. Right? There's only a couple things you really need to know to understand options. Okay, somebody sent, my boss actually 24 years ago said, and said this to me and it stuck. Said there's 2 things you need to understand. There's going to be 4. But 2 main things. He's like, this was a big aha moment. He's like, Brian, all those complicated options you hear about, like condors, butterflies, all that stuff, it's just made up of calls and puts. So just focus on learning what a call is and what a put is, and what it means to be a buyer and a seller. And you could figure out everything else. And that was like mind blown, right? I was like, holy cow, that's it? I thought a condor was something totally different. It's just made up of calls and or puts. right? So what I'd like you to do is, if you have a piece of paper, I told you to get pen and paper handy, draw out a 2x2 grid. And on the left-hand side, put the word calls and puts. Okay. And then across the top, we're going to put buyers on the right and sellers on the left. Okay. And then we're going to fill in these boxes. Okay. So if we take a look here in this top right box, actually, let me fill this in first. Right next to the word buyers, put the word rights. I just want you to understand, anytime you buy something, you have rights, and anytime you sell something, you have obligations. Okay, and the same is true when you go to the store. If you buy something, you have the right to return it. You have the right to expect it to work. You have rights as a buyer. When you're the seller of something, you have obligations to deliver something. Like at Walmart, you have the obligation to deliver a working product. Okay, so this top right box is going to be the buyer of a call, and they have the right to do what? They have the right to buy. Okay, so they have the right to buy a stock. Don't worry, we're going to add to this later on as we go through the webinar. I like to call it adding layers to your knowledge sandwich. Right? I'm not just going to shove a 6-inch sub in your face and just expect you to eat it. You choke on it, right? So we're just going to do one layer at a time. First layer is understand that the buyer of a call, they have the right to buy the stock, which means the seller of the call is the other side of that, which is they would be obligated to sell the stock if the buyer chooses to exercise his rights. See how they go together? And then down here with the puts, the buyer of a put also has rights, but they have the right to sell a stock, which means the seller of the put is the flip side of that, obligations to buy the stock if the buyer chooses to exercise his rights. All right. Here's a little extra piece of info that I thought was cool when I drew this out. If you connect these two boxes with an up arrow, that up arrow kind of looks like the market going higher or a stock going higher. The two boxes that it intersects are the two bullish trades in this core four. Buying a call and selling a put are bullish trades. You want the underlying stock to go up. The other two are bearish trades. Little tidbit, I just wrote that, stuck it on my desk, and just referred to it over and over until it's stuck in my head. All right. Next, the way I like to teach something is to start with something that you understand. So we're not going to start off with an option trade. I'm going to start off with a stock trade. This is a graph of Apple. Now, first, I'm going to talk about the elephant in the room. I know Apple is not currently trading at 129. Right? It doesn't even matter that this is Apple. We are looking at an example from years ago of Apple, but it is a great example to help you understand the concept. Okay, so it doesn't matter what year, what date, or whatever. It could be stock XYZ. Okay, but I'm just going to keep referring to it as Apple because that's what's typed on the screen. Here, Apple was trading roughly right around $130. And this is where I'm going to ask for some quick interaction in the chat. We'll see who gets in first each time. If Apple's trading at $130, how much would it cost to buy 100 shares? Let's see who's first. Oh, man, it was a tie. Eric and Pierre, but Eric, I think you slightly beat out Pierre. Yeah, you're getting it. Kumar, James, it'd be $13,000, right? 13,000. It's just 130 times 100. Here's a couple of scenarios that could happen after you buy a stock. Scenario number one is that Apple could drop. Remember, you bought it at 130. Let's say it drops a few bucks down to 125. I'll just answer the first part. How much are your 100 shares worth now? They're worth 12,500. But the key question I want to ask you is, do you have to sell? Like, you bought the shares. Do you have to sell? Yeah, Kumar, your first one in. Mahesh, just behind. No, you don't have to sell. Remember, you are the buyer. A buyer has the right. You have the right to sell if you want, but you're not obligated to sell your shares. And then the other scenario is Apple could go up. Apple's up to 140. Your shares are worth more, right? They're worth 14,000. And again, the same answer. Do you have to sell? The answer is no. Okay, so let's fill in this table. We're going to use the same type of table when we look at an option in just a moment. Give you a quick lay of the land. Over on the left-hand side is the stock's price. I could only fit 5 examples over here, but just understand the stock could go lower than 120. It could go higher than 140. I just could fit 5 over here. This next column is the initial cost out of pocket to place the trade. All right, so we're going to fill in this box. And then this next column is going to be how much money you get back when you close the trade. And then over here, this is how much resulting profit and loss you got. So over here, the initial cost you told me earlier was $13,000. The key thing I want you to understand here is that doesn't change. You spent $13,000 to enter the trade. The stock could go up, it could go down. It doesn't change the fact that you spent $13,000. Over here, this is how much cash you're going to get back when you close the trade. So if Apple was still at 130 when you close the trade, you'd get back your $13,000, right? So no profit, no loss. If Apple drops, you lose 500, then you lose 1,000, and then if it goes up, you make 500, you make 1,000. Right? It's like a one-to-one relationship here. Key questions. What is your maximum profit when you buy shares of a stock? How much money could you make, assuming Apple could go to 200, 300, whatever? What is the most you can make? Oh, you guys are quiet now. There we go. Thank you. See, I'm not going to move forward unless you participate. Unlimited and infinite are the 2 answers I'm getting in the chat. Unlimited is what I got on my slide. And what's the most you could lose? Kumar, you're the first one. Eric, slightly behind. Yeah, you got it. 13,000. All right. It's now granted, hopefully when you buy a stock, you actually have stops in place and you're not going to let a stock go to 0 and lose the full amount. But in reality, that's what you're risking. You said it right, Pierre, the initial cost. Let's look at it now from the perspective of somebody doing an options trade. Here's Apple again. You are once again bullish on Apple. You think Apple's going to go up, but instead of buying 100 shares of Apple, you buy the right to buy Apple. If you remember back from our 2x2 grid, pardon me, when you're buying the right to buy, that means you're buying a call, right? Okay, so you're not actually buying the shares of Apple. You are buying the right to buy Apple. Okay, you're buying the right to buy, which means you are buying one call option on Apple. By buying one call option, it gives you the right to buy Apple. And in our example, we're choosing $130. Where does that come from? Well, when you buy your call, it's going to give you the right, and there's going to be some terms and conditions on this. It's called a call contract. First part is when you buy one call, each call contract controls 100 shares. So you buy one call, it gives you the right to buy 100 shares of Apple. If you did 5 calls, it would be 500 shares. Okay? But in our example, we're doing one call at a certain price, and that's called a strike price. And we'll talk about that later on in today's webinar. Don't worry. We'll come back to that. In our example, our certain price or our strike price is 130 by a certain date, which is an expiration date, which we'll talk more about later. I'm not talking about it right now. But those are things you set when you buy the call. Your one call does cost you something, right? Since you're in this example, what you would see with your broker is your broker would say that the call costs $3.65 per share. That way, you can then say, all right, I'm doing one contract that's 100 shares. So it's 100 times the 365. So if you did one contract, it's $365 for this example. Okay, and if you did 10 contracts, it would just be 10 times that. So let's look at the same 2 scenarios. Get your thinking cap on. You're now the owner of a call and Apple drops. It is now down to $125. Would you want to exercise your right to buy Apple at $130 if it's trading at $125? Blair, Brianna, Pierre, Frank, everybody's saying no, except there's one yes in there. All right. Well, the answer is no, right? You're not going to want to exercise your right to buy something at a higher price when you could just go out to the open market, and if you really wanted it, you could just buy it at a lower price. So you're not going to want to do that. Scenario number 2. Apple's now up. It's all the way up at 140. Would you want to exercise your right to buy Apple at 130 if it's currently trading at 140? So you could buy it at 130. It's trading at 140. All right, so I see a bunch of yeses coming in. Yes, yes, yes. I see a sure. I see Blair says perhaps. Yeah, I'm going to actually go with what Blair says. And I'm going to say perhaps or maybe. You definitely could, because that is your right. Or what you could do is just sell your option to somebody else. Right? Options trade just like stocks. You could just take your option and be like, oh, cool, I have a profit. I'm going to sell it to somebody else because it's worth something to someone. All right? Because maybe you don't have the money to buy Apple. Maybe you don't even want to own Apple. You're just trading the option. You could just sell the option to somebody else. All right, we're going to fill in this table for the option now. Same left-hand side with the stock price. Do you remember what the cost of our option was? We're going to fill that in right here. Yeah, Chris. Hey, Chris, you're first one in this time. You beat Blair. It's $365. All right, or as some of you are saying, $3.65 per share. This column is going to be what is the option's value. And now I'm going to throw back in the term expiration date. So we're going to picture this option at the expiration date where you have to make a decision. All right. You're going to have to say, all right, I'm going to either exercise my rights or close this trade, but a decision has to be made. If Apple was trading at 130 at the time of expiration and you're like, all right, what do I do? Well, the option's value is 0. Which means you'd be out your 365. And for the longest, I don't know about you, I'm going to tell you, it might be an embarrassing story, but for the longest time, I sat there and I'm like, what are you talking? How's it nothing? I mean, the stock's price is 130. I have the right to buy it at 130. How could it be worth nothing? Well, then I start to picture myself going to like Burger King or McDonald's. And let's say you go to McDonald's and you have a coupon to buy a Big Mac at $5. And you look up at the menu and a Big Mac is $5. Would you use your coupon? No. Would the person behind you be willing to pay you money for your coupon? No, because it's not worth anything. Because the Big Mac or the Apple stock price is trading the same as your option. So it has no value. You'd be out what you spent. And the same is true if Apple went lower. The option would still be worth nothing. But then let's say the other scenario, Apple goes up. So now it's up at 135. That means there's $5 of, it's called intrinsic value. Your option now is worth actually like $5 a share. Because if you think about what's going on in the background, you have the right to buy Apple at 130. You could exercise that right and then immediately go out to the open market and sell it for 135. That's a $5 benefit to you. $5 times the 100 shares that you're controlling is a $500 value. But for you, since it costs you $365 to buy the option, you'd see a profit of $135. Still good, right? And of course, if it goes higher to 140, that's a $10 benefit or $10 of intrinsic value. $10 times the 100 shares is $1,000, and subtract out what it's cost you is $635. Still pretty good, right? Same two questions. What's the maximum profit on this trade? When you buy a call, what's the maximum profit for you? Assuming Apple can go, assuming I had a big slide and I could fit in Apple going to 200 or 300 or whatever. Yeah, Brianna, you're the first one I got right. Daniel, Mahesh, unlimited. Yeah, infinite, unlimited. Was Apple could go to $500 a share. What's your maximum risk? What's the most you could lose on this trade? Oh, who got it first? Mahesh, you beat everybody. $365. Yep, that's the amount you spent. That's a big difference between that and what was it, 13,000? Okay, so let's see what does this mean for you as an investor. Here's kind of how that trade would have played out. The two different types of people who are trading. You got the investor who buys the stock and the option trader. On February 6th of that year, Apple was trading at 129.73. And you could have bought the stock. Some people see this pattern like, oh, rising stock price, it gaps up maybe on earnings, and there's follow through. The stock continues to move higher. Like, great, I want to buy Apple, which is fine. You could buy Apple at 129.73. About a month later, Apple rose to 139. Well, if you just bought the stock, you're happy, right? You made 7.7%. That's great. Let's fill in this table. The first row is if you bought 100 shares of Apple. It would have cost you $12,973. A month later, it was worth $13,000 and change. You profited $1,000, 7.7%. But let's take a look at the option. If you did that one contract, like we said a moment ago, it was $365. That's how much it cost you. A month later, the option was actually worth $1,080. So you could have taken that option and just sold it to somebody else. Somebody else might have wanted it. So you just sell it to them. They pay you $1,080, and you net the difference, $715. That's a 195% gain on your investment. This is one of the reasons people love options. They get really interested. They're like, man, instead of 7%, I can make 195%. But first off, hopefully you'll learn this about me, or this about me. I'm not here to get you all enticed about options. Like, oh my goodness, I'm going to make 195%. That's not the point. That's actually one of the things we try to avoid people to think about is these huge gains, because then you start making mistakes and you get greedy. A couple of the points I want to make here. First off, would you kind of grant me that $700 is close enough to $1,000? Like, they're, in the grand scheme of life, they're roughly the same. All right. Yeah. Okay. For a lot less of an investment. All right. So instead of spending $13,000, you spend $365 and you can make the same amount, which means what can you do? You could either do more contracts. You could invest in other opportunities that are out there. You could diversify. And like I said, you could do more contracts. So maybe you do 3 contracts. It's still only an investment of $1,000, $1,095, because it's just 3 times that. And your profit is $2,000. Still the 195% return on your investment, but now you're at a $2,000 gain. And you remember my promise earlier, by using options, it could help you possibly double your annual returns. Here's my first example. Instead of doing your typical stock trade where you make 1,000, you do this option trade and you doubled it. All right. And let's say you did more contracts, like 10. It's still only 3,600. I mean, think about it. You were willing to put 13,000 in. Maybe you'd say, all right, well, I'll just do 3,600. So instead of a $1,000 profit, it's now a $7,000. And if you just think to yourself, like, all right, what if I mixed a couple of these in throughout the year? Right? I'm not saying you're going to become a full-time options trader like Ron. Ron trades options a lot, right? What if you did it just when the time was right? Like, there's going to be more opportune times than others to buy calls and buy puts. Do it then and reap the benefits. The other thing that I think there's 2 other things I want to point out is we teach a full options course. We obviously can't go through everything today in this 1 hour, but Ron is actually going to head up teaching an options course called the Options JumpStarter, where he's going to work with you for 6 weeks, and he'll do real-time examples of these, not these historical examples with Apple, but he'll be able to find these trades with you in real time. But one of the points is the way we teach options is you're never going to risk the full amount. Even though it might cost you $1,000, you'll never be losing the full amount. So those of you who have ever bought an option and watched it expire worthless, never do that. Okay? The other point I want to get across here is, let me get my pen. Hold on one second. There we go. If you did this trade right here, if you're a stock trader, I'm going to use a 10% trailing stop. Let's just say 10%, even though you might use 15, 20, or the VectorVest stop, but let's just say you do a 10% stop. If this goes against you 10%, that means you're going to lose $1,297, right? And you'd probably not be happy, but you'd say, all right, I had a losing trade. I'm going to move on to the next one. Well, gee whiz, right? I mean, if you're going to be willing to enter a stock trade and you say, all right, my loss is going to be $1,297, wouldn't it make sense to do one of these two guys, like that one or that one, instead when the time is right? Like, well, all right, the most I can lose on this one is $365. The most I could lose is $1,095. Even though, like I said, we're going to teach you ways that you don't lose that full amount. Never let an option expire worthless, by the way. All right. Hopefully you got from that section. I don't want to like lure you in with the promise of big profits and get you all glassy-eyed, like, oh my goodness, 195%. That's not our style here at VectorVest. That's not mine. We want to teach you the right way to do it. And you don't have to be a full-time options trader. Just mix options in when the time is right. Mix in a 2 every once in a while instead of a 1. Mix in a 7 every once in a while instead of a 1. All right? That's how you could possibly double your returns. And I'll just ask you this. Like, if you had this working, if you were doing that, like mixing these in every once in a while, what would be the impact for you? I'll give you 10 seconds. I know I went a little longer in that section because I really wanted to make sure you understood the concept. Blair's like, it'd be awesome. Yeah, if you mix in a 7 instead of a 1, I mean, I think the spouse would be happy, right? He'd be like, hey. James is like, yeah, it'd be a plus. Exactly. It'd be a huge benefit. So one of my jobs today as your coach is to help you make a few great decisions. Right? Your first shift is to move from just doing stocks to where you mix in some options. Right? Still do stock trading. I'm not saying stop, but mix in. So I'll give you a choice right now. In the chat, kind of this is it, like where you kind of draw a line in the sand. Type in the word stocks or type in the word mix. So type in the word mix if you're saying, you know what, I really should start mixing in some options. Yeah, Blair, Craig, Mahesh, James, Bill, Eunice, Doe, Chris, Brett. Yeah, mix. Right? So you see, my promise to you was that you could start doubling your annual returns by using options. Using leverage and mixing in some options is a key component of doing that. All right, now let's start doing let's add to that knowledge sandwich. Now that you know you want to start using options, you got to know how to trade them correctly, because most people see those big percentages and they just go out there and start buying options. They're like, cool, Brian, I got it. And then you log off from the webinar right now and you just go buy a call. No, right? You want to align your trades to give yourself the highest chance for success. And by the way, might be nearing one of those times coming up soon in the market. I like to think of it like playing the match game. You remember also like the memory game? I know as a kid, I would flip those cards on the carpet with my brother. And then it's like you flip over one and then it's like an elephant and you have to flip over another one and see if it's an elephant. The match game. So basically, if you're flipping over these cards and you have one card that says the market's going up, the other one says the stock's going up, the other one is a bullish trade, that's a match, right? So if you're flipping over cards and there's a mismatch, like if the market's going up and you pick a stock, but you're going to do a bearish trade, that's a mismatch. But what most people do in a mismatch is they don't even pay attention to the market, and the market could be going down, and they just pick any old stock. Maybe it might be a stock going up, but the market's going down, and they buy a call. That is a mismatch, right? You don't want to have the market going down and doing a bullish option trade. Okay, so this is what that looks like when people do it wrong. Let me see if I can erase my drawing here. There we go. All right. For some reason. There we go. For some reason, my drawing was on my screen forever. All right, so here's a look at NVIDIA from a while ago. Just to illustrate a point. I mean, this stock is one of the most popular stocks when it comes to options. A lot of people trade NVIDIA options. They'll see a stock going up. NVIDIA goes up quite a bit, right? And the stock goes up, and they'll be like, cool, I'm going to buy a call. After they buy a call, it goes down. Well, they're like, what just happened? AMD is another popular option trade. They buy it, it goes down. Tesla, it goes down. Right? And when the stock goes down after you buy a call, you're going to lose money. You might have thought you did everything right, but you still lost. And when that happens, it gets frustrating. You end up not knowing when to place a trade or which stock to place a trade on. But why is this happening? If you look back at all these examples, kind of look down at the time. That year, it was November of 21. Well, what was going on in the market at that time? The market looked like it was going up, but it started to curl over. In fact, at that time, our system gave a confirmed down call that day. And when the market goes down, it pulls most stocks down with it. And when you don't pay attention to the market's direction, especially option trades, especially, more times than not, won't work out. You want to give yourself an opportunity for those explosive gains. And to do that, you need to pay attention to the market's trend. All right. So here's a look. I brought it up a couple of years closer to current. As you can see, the market has trends. It goes up, it goes down, it goes up, it goes down. All right. We do have signals that help us determine the market's trend. Here at VectorVest, one of our signals is the DEW. It's a good intermediate signal. Ron uses that a lot in his options group to tell him when to be bullish or bearish on trades. So it does a pretty good job of saying, all right, hey, down signal, market's going down. Up signal, market goes up. Right? It doesn't predict the market. It just says, hey, the market's in an uptrend. It's okay to be bullish. So here's a couple of examples. I highlighted a date of February 21st over here. That was a day we had a DEW down signal. Basically, the market was signaled going down. Well, you don't want to buy a call, right? Even if it's on NVIDIA or AMD or whatever. You want to buy puts on bad stocks, right? Don't buy puts on good stocks. Buy puts on bad stocks because you want them to go down. One of our top bearish searches found CLFD. You see how that's the top stock? You don't always have to trade the top stock. Ron will talk about that if you choose to join us in the full class. But in this example, it was the top stock. If you look at the graph, I mean, isn't this an ugly looking chart that you'd really want to be bearish on? Right? The stock is going lower and hitting new lows. Okay, it's a perfect candidate to buy a put on. What I have here is a screenshot from our options program. Not that you need to use this options program. I'm only using it to highlight what happened with the trade. Right? It's the only way I could visually show what happened with this option trade. All right, we'll talk more about setting up the trade in the next section. But here, if you look, it says long put. That just means you bought a put, and this is the date, February 21st of that year. It says buy one. Remember, one contract. And it costs us right here $5.05 per share, which means it costs like $500, right? $505. In just like 15 days, couple weeks, The way that we teach options is to look out for profit objectives, and the profit objective was hit, and the option gained 99%, which was over $500 in 2 weeks. All right, now you might look at this and you might see, well, hold on a minute. That option, if you had just held on a little bit longer, you would have made double that, 1,000. Well, yeah, but you got to follow rules. Don't be greedy. We have rules for a reason. A profit objective was hit in 2 weeks. We close the trade, make your $500, you move on. Don't make the same mistake I did when I first started trading options. I bought a call, was up like 80% in the first couple of weeks. I'm like, awesome. Imagine what it's going to be like 2 weeks from now. Well, guess what? I ended up closing that trade for 5 cents because I didn't want to let it expire worthless. So I took 5 cents. Don't do that. Don't make that mistake. All right. Now, when the market flips around and you get the up signal, you want to find good stocks that are rising in price. And one of our bullish searches that we like is ruler stocks. It found some great candidates. All right. There's a lot of talk about the Mag 7 and all that. And one of them is number 2 in this list. You got NVIDIA right here. You might not want to buy shares of a $450 stock. That's a perfect reason to trade options because it's not going to cost you. You don't have to spend $450 a share. Here's a look at NVIDIA. Great looking price, great looking earnings. This type of stock typically rises during market uptrends. And you can see that here. When I overlay the DEW signals, it correlates nicely. It gives you more confidence, like, oh, cool. I got a DEW up signal here, the stock went up. A down signal, the stock went sideways. Up signal, well, that one went sideways. But more times than not on these up signals, stock went up. Up signal, stock went up. Now we have another up signal. Probabilities on our side that we have a good stock, rising in price, rising earnings, that it's going to go up. So we're going to play the probabilities there. So I zoomed in closer to that day, and here are the trade details. Buy one call, and it cost $40 a share. That's Brian. That's so much more than the ones you were showing us before. Well, $40 a share is a lot less than $450 a share, right? But so one contract would have cost you $4,000. Right, so it's a little bit more than what we've been talking about. So $4,000, but just 1 week later, the profit target was hit again, and this one was $1,800. So you made $1,800. So the stock went up 7.5%. That option gained 46% in a week. So the point of this section of the webinar is, when you do it at the wrong time, even good stocks, right? When you have no match, even good stocks could end up in losing trades. You want to do it at the right time. You want to match the market with the stock and your option trade. There's a huge difference. And you could do this when the market's going up, but the cool thing about options is you could do it when the market's going down too. All right? All right, so I'm just going to answer this in the case of time here. When you align your trades, do you have a competitive advantage? Yes. And guess what? Coming up soon, just looking at our market, the market is getting very oversold. Not quite at our levels. Ron will teach you about that in the full course, but there could be a very opportune time for calls coming up. Maybe not today, but coming up. All right, so anytime or align. So just in the chat, like just promise. You don't have to promise me. Promise yourself. If you type in the word align, you're promising yourself that when you go to buy a call or buy a put, you're at least going to make sure that it aligns with what the market is doing. All right, everybody's typing in the word align. Perfect. All right. All right, section 3. Now that you know you want to start using options and align your trades, you got to know how to set them up correctly, because a lot of people just learn the basics and they just don't pick the right strike and the right expiration. I picture it as a chess player. You got to be able to think ahead and kind of plan things out before you actually put your hand on the piece and move it. This time, hey, guess what? We're not using Apple. We're using Home Depot. I mean, this is a nice looking chart at the time. I know it's from several years ago, but it could be stock XYZ that was rising in price. You're like, cool, I want to buy a call. But what do a lot of people do wrong? Well, they buy a call, but they set the strike way up here. Right? The stock was trading down here, but they set their strike way up here because it only costs $47. But what are the chances that Home Depot is going to get up there, especially considering there's an expiration date involved? I mean, it's going to have to go up quite a bit. Typically what happens is their expiration date comes, and even though Home Depot went up, it went from here up to here, it went higher, it didn't go up enough, and the option expires worthless. We're not going to do that. Because that, what happens to a lot of people is they take all these small losses. It's like a jab. And, a boxer, you might not take this big roundhouse to the face and get knocked out, but a boxer takes like a little jab, a little jab, a little jab. Eventually, come the 15th round, they're just falling over. Right? You don't want your portfolio to die a death of 1,000 cuts. All right? Don't slowly bleed your portfolio. You want to put probability on side. So on your side, we're going to talk about 2 core problems. And while we talk about them, I'm going to show you how to fix them. Okay? So the 2 core problems that most option traders make are, first off, the first one involves time decay. What you're looking at here is what happens to the price of an option in relation to the number of days until expiration. So nothing else changes, right? Nothing else. No presidential tweets, no wars, no volatility changes. Nothing else changes. The stock's price doesn't change. The only thing that changes is time. And down here you can see as, let's say 180 days ago until the day of expiration, the option price does this. What I want you to notice here is that it takes 135 of those days for the option to lose half of its value. In the last 45 days, it loses the other half. So when you buy an option, if there is less than 45 days left until expiration, time decay is eating away at your possible profits. Here's a look at Home Depot, and this hopefully will help you visualize that. A lot of people choose an expiration date here. Remember, right here was the trade date. They choose an expiration date here, which is within 45 days. They choose an expiration date here, which is still within 45 days. And if I overlay that time decay, even though the stock's price goes up right here, this is like pulling it down. It's counteracting that up move of the stock exponentially as you get closer to zero. It's like you could still be a great swimmer, but if you tie a cinder block around your ankles, it's going to be very tough to stay afloat. Right? You want to give yourself enough time to be right, and that is not in the last 45 days. Okay? What we look at, and the way that we do it right, is when we're buying a call or a put, we're going to give ourselves 60 to 90 days till expiration. All right? So you're going to give yourself more time. The other problem involves where people pick their strike. They pick a strike price that is so far away and has little chance of getting hit. Why do they do that? Because it's cheaper. The farther away you pick, the option gets cheaper and cheaper, and they're like, oh, cool, this is like a lottery ticket. You only spend a dollar, and you're hoping to win a big amount. Well, I'm going to ask you, all you in the webinar, when was the last time you won the Powerball? Right? When was the last time you won the lottery? Well, your chances are going to be the same when you buy lottery ticket options. Yeah, players and Kumar are like, never. All right. So probability decreases the farther away you get. All right, so this is how to do it wrong and how to do it right. So here's scenario number 1, how to do it wrong. You pick a strike price. All right, remember the trade date was here. You pick an expiration date just 1 month away. That's within 45 days, so that's too close. You pick a strike price way up here. That's too far away. The result is you lose $460. It's like, remember, death by 1,000 paper cuts. A little loss on the next one, a little loss on the next one. Well, same stock. This is the key here, folks. Same exact stock, same exact trade date. We're not doing anything different. All we're doing is doing the setup correctly. We're choosing an expiration date farther away. We're choosing a strike price like right near where the stock's price is. That's a good rule of thumb to start with. Ron will teach you more details in the full course, but a really good rule to start is basically right where the stock's price is. Yeah, the option would have cost you more, but you have a higher probability of winning. This one would have been a gain of $8,000, 158%. But hey, like I said before, we're not going to hold these trades till expiration. Let's say you walked away with half of that. Back here, $2,500 gain. You're still doing it the right way. Right? We're not going to hold these trades till expiration. So I want you to choose no rules or high probability rules. Hopefully you're going to say high probability rules. Okay? Now today's been all about building your option trading system to possibly double your annual returns. I want to share with you how the best option traders build their system. Right? There's 5 steps. All right, the first one, no matter what you do here at VectorVest with us, you will notice the first step is always going to be look at market direction. A lot of traders ignore market direction and they just go out and place trades. And as you saw today, aligning your trades is extremely important. So make that number 1 on your list. First step, check the market's direction. Okay. Second step, after you know the market's direction, you want to find stocks that are highly likely to move in the same direction as the market. You don't want to just trade stocks that you know or hear on TV or from the gurus. What you want to do is find good stocks that are already in uptrends when the market is rising, and you want to find bad stocks that are in downtrends when the market is falling. Then once you have your list of candidates, you choose your option. All right. We talked the simplest thing, you're going to choose a call or a put, right? So when the market's going up, you're going to choose calls. When the market's going down, you're going to do puts. All right. But there's other things that you're going to need to look at, things like open interest, volume. We didn't have time to get into some of those finer details today. After you choose the option, set up the trade for high probability of success. Right? One of the things we didn't have a chance to talk about today was determining the best risk to reward setup. All right. We did talk about how to pick the right strike and the right expiration. That'll help quite a bit in the trade setup. And then trade management, we didn't really get into that today. I talked to you how we're not going to hold it till expiration. This is where you're going to have a plan in place to know how to manage your trade after you're in it. Right? But you're going to decide this before you place the trade. Right? You want to know what you're going to do if it goes for you or against you. Okay, so just very quickly, of those 5 things, would you say are you 5 out of 5? Like, do you have them all? Because the idea is we want to get checks all the way down, right? Let's just, if I get my pen back, we want to be 5 checks all the way down. Yeah, Brianna's like, I'm 5 out of 5. Awesome, Brianna. In the chat, let me know. Are you like 4 out of 5, 3 out of 5, 2 out of 5, 1 out of 5? Like, I'll put it this way. If you have a way, if you're a VectorVest member, you should have a way, you should have a way to do the first one and probably even the second one if you use Unisearch. Yeah, so the idea is you want to get checks all the way down, 5 checks. All right? And just say, all right, what did I just learn? And the idea is where you don't have a check, that's where you need to start working. All right? Most likely you showed up today. Maybe you didn't know where to start. Right? But you know options can help you increase your returns. Maybe you felt confused or intimidated by all the terms. Maybe you have been one of those people who have been taking loss after loss, but you still wanted to learn how to leverage your money with options. Wherever you showed up, I hope you see that your system determines your option success. And I hope you saw that it is possible to grow your portfolio much faster if instead of just buying stocks, you start to mix in a couple of options here and there. It's possible to make money with options and see those explosive gains if you align your trades with what's going on in the market and you use high probability rules. So, I mean, do you see how powerful options can be when done right? Yeah, yes. Now, at the start, I promised I was going to give you everything I could. I was going to show you everything as much as I could in an hour. And I mentioned a couple of times in today's session that we do have a lengthier course to help you get faster results. Like if you really did want to learn how to use options, I mean, you could say, all right, well, Brian, tell me about that course. Well, I'm glad you asked, right? I'm going to tell you about this course. If you feel you're at that point, you want to take that next step, now's the time to decide. I mean, you could decide to leave today's webinar and be like, I'm cool. I'm going to try it alone. But the downside is you might learn by trial and error, which can be painful if it's like me holding a hammer, right? Or you could bypass all the mistakes that I know I've made and just basically take the course and learn how to do it right the first time and start trading them the right way from the get-go. So I want you to get results quickly. That's why we did put together this 6-week course called the Options JumpStarter. It's a complete system, shows you how to buy calls and puts to profit in both up and down markets. We will take you by the hand, guide you through the entire thing, every step by step, to help you find the trades, set them up, manage them the right way. So if you're new to options or have struggled with them in the past, this is the course for you. A lot of people ask us, like, where do I get started with options? Well, it's been a year, folks, since we've launched this course live. We're doing it live right now. It's been a full year. So we put this course together for people who want a system to trade options the right way. Roger said it best. He said he had recently quasi-retired, having left his company after 24 years. He took this course to learn the basic strategies to reduce risk and gain better odds for success, and he loved it. He says, if you're like me and you've never traded options before, I would stress that you should not make a move until you've completed this course. He says, emotionally, I'd say that when I do enter my trades, I do so with much more confidence. And he says, psychologically, I feel the outcome of my trades will be positive and I'll be making money. And that puts me in a great psychological state, as I know options do not have to be a gamble like a roulette wheel, as I previously thought. All right. So let me just kind of walk you through it as quickly as I can. I want you to understand what it's all about. All right. So module 1, we lay a very strong foundation. That way you don't get frustrated by the terms. We talked a little bit about it today, but the outcome you're going to get here is complete clarity on how options work. You're going to get a clear and easy to understand framework. You'll know how calls and puts work, right? So you're not wasting time or getting frustrated. Then module 2, we're going to be laser focused on calls, right? Because you want to take advantage of those explosive up moves because they could really make your year. You're going to learn the exact signals to look for to identify market blast off phases so that you know the best time to trade calls, and the exact rules for the right trade setups. And we're going to flip it around for puts. You're going to know what to look for when the market is going down, how to identify it, and how to take advantage of those market downturns. Because a lot of people get frustrated or angry when the market goes down because they see their portfolio stalling or they're giving back gains. Now, module 4 is all about trade selection. That's where you're going to learn, all right, how do I find the best stocks for my trades? How do I match those stocks and find the right ones for option trades? Not just, I don't want to just buy a stock. I want to find which ones that work best for options. We'll do that in module 4. Module 5 is where we didn't talk a lot about today, but this is where you're going to learn how to manage the trade so you're not like a deer in the headlights just frozen, right? You're going to know exactly what to do in every situation, when to take profits, when to close at a loss, how to manage the trade. And then module 6, this is where we get you completely confident that you can actually go to your broker and place the trade, right? You don't want to go to your broker and not ever having seen what an option chain looks like or how to place an option trade. That's where we're going to walk you through it. By the time we're done, we're going to have that straight line system. Check, 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 all the way down. Now you're going to get a couple of bonuses with the course. You're going to get a covered calls bonus. Ron uses covered calls every session, basically every week with the retirees. It's a great way to generate income, right? In fact, Doug said, I wish I'd taken this course 20 years ago because it gives the basics of puts and calls, right? With some simple rules and strategies that you can understand and implement very easily. He says the bonus session on covered calls alone makes this course worth it, right? Now, those of you who are here who are not currently VectorVest members, we would give a 60-day trial to the VectorVest service so that you could see what it's like. We think it's the best tool out there to determine market direction, find stocks. It'll drastically reduce the amount of time you spend implementing the system. Pardon me. And now those of you who choose the mastery package, because by the way, we have a self-study version and a mastery package. Today, while we're on the webinar, I'm going to give you a little hint. The mastery is going to be the same price as the self-study. So stay tuned for in 60 seconds. I'll tell you about that. These live mastery sessions are designed to help you actually implement the things. All right. Ron's going to jump on there. He and Todd are going to get in there in real time with you and take a look at what's going on in the market in real time and make sure that you understand everything that's going on in this course. All right. And if you can't make those real-time sessions, no problem. We'll give you a private email address. You can submit questions, right? You can watch the recordings. So you're going to get all these things, right? For this course, value over $2,000. We do have two options. Typically, when we would do this course, like after today's webinar, the prices will be a $295 self-study and a $495 mastery package. But if you register for the mastery package while we're on the session, which probably about 15 more minutes here, it'll be the same price as the self-study. So it's basically a no-brainer, right? Just choose the mastery package. That way you get all the live sessions, all the live bonuses. All right, so it's only $295. It's a huge value, right? But it's only for people who register while we're on today's session. Just go to vectorvest.com/jumpstart. I'm going to put that into the chat for you. Just www.vectorvest.com/jumpstart. And when you go there, there'll be these same two choices. Just choose the mastery package. All right. And after the course, if you show that you've done the work and you still want your money back, it's completely no risk. We'll give you 100% money back return. We do ask that you do the work because we know if you do the work, you're going to see the results and you'll be like, wow, there's no way I want my money back because I'm actually making money with what I'm learning in the course. David said the Options JumpStarter was the perfect course for the beginner. He said it taught me all the basics that I was looking for. Great staff and a great course. Financially, I'm up $100,000, tenfold compared to buying and holding stocks in a very short time. He says the leverage is wonderful. I would recommend this course for everyone that wants to live comfortably or have the ability to retire. This course and VectorVest are a blessing. All right. Now, I can't guarantee that you're going to make $100,000 like David did, but it is possible, right? But we're going to teach you how to do it the right way. Just ask yourself, how much is it costing you not to do this? How much is it costing you if you did nothing? How much money have you lost trading options incorrectly? How much potential profit will you miss out on because you don't know how to use options the right way? And how much time and energy will you spend trying to do this on your own? And then just ask yourself, all right, well, if I did this and it actually worked, how would my life be different? All right. So if you order before the end of today's webinar, you get the mastery package for only $295. If you wait, the price will go back up to $495. Okay. So when you go to vectorvest.com/jumpstart, you'll see a page that looks like this. Just hit the big button that says register today. And when you do, you'll be brought down to a part of the page that looks like this. Just hit mastery package. It might ask you to put in your email address and sign in. Okay. Again, if you order before we're done, you get the mastery package for the same price. It's $295. After the webinar, it goes up to $495, which is still a great price. Monday evening, the price goes up to $795. All right, so don't wait. Now would be the best time to get in. So if you're in, we've had a bunch of people already join the class. If you're one of them, in the chat, just say, I'm in. Some people type in the word amen. I actually said the word I'm in, or the two words I'm in. So you can type in amen if you want. That's fine. But just type in I'm in because you'll get an email from us with all the details. So as soon as you register, you'll get an email with the dates, the times, all of the details will be in that email. Plus, you have access to the course immediately. So you could start going through the material right now. All right. And a lot of people say, all right, well, when are the live sessions? Well, the first one is April 1st. No, that's not a joke. It's not April Fool's. That is the first live session. And so what is today? The 18th of March. So you actually have a couple of weeks to start going through the recorded class, jotting down your questions. You could email in your questions to our private email address and get a head start on the coursework. Because I'm telling you, there could be a time coming up soon that would be an opportune time. Now, I can't predict what's going to happen in the market, but if you've noticed, the market's been going down quite a bit. There's going to be a time where it stops going down and starts to go back up. Yeah, so there are the dates and the times. The 11 a.m. Eastern time. We like to do it during the market day. That way you can see what it looks like in your brokerage account when the market is open and when options are moving. Okay. So again, VectorVest.com/jumpstart. Also in the chat, let me know, how was the session, right? So I promise you I was going to give you everything I could. I wanted to make sure that you learned options. I wanted to put it together in a way that you could walk away saying, you know what, I have a really good understanding of the basics of options. In the chat, let me know. Was that part successful? And also let us know if you're into the class. Oh, and thank you for reminding me, those of you who were asking for the slides. Let me find them. I just dropped them into the handouts area for you. They're uploading now. All right. Jim said, Jim, people are going to think you're a plant from VectorVest. Jim in the chat says, I'd like to take this course. How do I do it? Well, Jim, I'm glad you asked. Jim W. Jim, just go to VectorVest.com/jumpstart. Just pull up any web browser. I'm going to see if I can get a web browser here. And www.vec. I know it's on the wrong screen. Oop, I typed it wrong. Hold on. There we go. When you type in VectorVest.com/jumpstart, it'll bring you to this page. It's just VectorVest.com/optionsjumpstart. Just a little redirect. When you're there, you can see it says webinar special ends in 17 minutes. All right, and then you just have to hit register today. You're brought down to a page that looks like this. Just click on Mastery Package for the $295. When you click on that, it should bring you to a page that looks like this, $295. And then over here, it asks for your email address. Now, if you put in your email address and you are already a VectorVest member, it wouldn't pop up. It'll just show a message saying that the email address already exists, and it'll just ask you to sign in. Just hit sign in, and that way it'll put the course on your existing account. All right. Now, if you have any questions about registering, just give our team a call, or you can let us know in the chat. All right. Our phone number, Stephen or Ron, could you put our phone number in the chat? It's just 888-658. I'll try to draw it on here. 888-658-7638. All right, so just give us a call. If you have any questions, well, ideally, if you have a question, let me know in the chat. I could answer it while you're here. Or if it's after the webinar and you happen to watch the recording, just give our team a call. If for some reason something's not working with the order form, definitely give our team a call. That's not something I could easily troubleshoot here. Mike says, good info. I already went through the program. Awesome, Mike. Joe says, I'm registered. Mike says, I loved it. Oh, I think he was saying, for those of you who are wondering, he said he already went through the program, and he says, I loved it. Kumar says, thank you, Brian. Just signed up. Awesome. Doe, if you're already a member of VectorVest, first, thank you for that. Doe says I'm already a member. Is my membership going to go up for the 2 months of the course? Nope. So if you're saying that you're on our VectorVest, I believe that's the VectorVest Basic subscription you've got, you will get 60 days of upgraded access to, I believe it's the Enhanced, which is the 15-minute delayed version of VectorVest. So you'll still be on your subscription of $69 a month for VectorVest, but you'll get the upgraded access for 2 months. It's like a 60-day trial to the upgraded. Now, if you already have VectorVest either Enhanced or a higher version of that, then you'll just be continuing on. I think there was a question from Kevin or so earlier on that. You'll just continue on with your existing membership, because this is basically kind of like when a lot of our VectorVest, our members first were introduced to VectorVest. You started out with like a 99-cent trial or a $10 trial for a certain number of days or weeks. This is kind of like that, since somebody is saying, well, I'm going to bypass spending 99 cents or $10 for a trial. I'm going to spend $300. We're including trial access to the software. Kumar says, thank you, Brian, just signed up. I think I read that one already. Awesome, Kumar. Andrew says, it was well worth the time and cost. Nice presentation, Brian and Ron. Thank you for sharing that, Andrew. All right. Well, if you have a question, let me know in the chat. I'll give you about 60 more seconds, and then we'll start to wrap up for the day. Just a quick reminder, you go to vectorvest.com/jumpstart. There's only about 10 minutes or so left of the $295 rate. It'll go up to $495 when that timer hits 0. On Monday is when the price goes up to $795. But then on Tuesday, we close registration. So Tuesday, registration will close, and then you can't get in, right? So this is a really short window to make up your mind, because we got to make sure we get the student list ready, and we're ready to go for the first live session. All right. Well, everybody, it was awesome having you here. And we look forward to seeing you in the class. Like I said, this is the first time we've taught this class live in a year, and we're looking forward to it. So join us at vectorvest.com/jumpstart, and we will see you at the first live session. All right. Take care, everybody.